Steve Divitikos. Welcome to Built to Sell Radio.
Thanks, John. Long-time listener, first-time guest. So I'm excited to get on here.
First-time caller. MicroA. Tell me the story of this company. How did you come to own it?
Yeah, so my path to entrepreneurship is I guess less traditional than most folks who might be listening to your show. So I actually purchased the company from its original co-founders. The co-founders were actually a father-son combination who founded the company in the basement of their family home 20 years prior to me knocking on their door. And I purchased the company through something called a search fund. And for those who don't know what that is, a search fund basically just describes a situation where a young entrepreneur takes roughly 2 years to search for and acquire a single privately owned business, and then subsequently becomes the CEO of that business. So as prior to running MicroA, I actually worked in the private equity industry as an investor, and I did that for a couple of years. But after being in the private equity seat for a couple of years, it eventually became quite clear to me that I just wasn't put on this earth to be a lifetime investor. I really wanted to be an entrepreneur. But at the time, I didn't know exactly what form that might take.
So I left. In your mind, Steve, sorry to interrupt, but what's the difference in your mind between an entrepreneur and an investor? Because we just had Anastasia, I can't pronounce her surname, on the show. And she talked about a 9-figure exit. And one of the biggest mistakes she made was start investing in small businesses because she didn't know what she was doing. And she subsequently found out that there's a huge difference between being an entrepreneur and an operator versus an investor. And it's, in her opinion, the two are like oil and water. They're virtually never in the same person. So in your mind, what's the difference between an investor and an entrepreneur?
Yeah, I don't know if I entirely agree with that, quite frankly. I started my career as an investor, became an operator, and not to get ahead of ourselves, but am an investor again. I do agree that they tend to be two very, very different skill sets, but I disagree that the same person can't necessarily have both of those skill sets. And if that is true, then I'm in big trouble.
Or a 1 in a million kind of person.
Yeah.
So,
Somewhat cheekily, I often refer to the difference between an operator and an investor as the difference between a chef and a food critic. Food critics can talk intelligently about meals, talk about how they're composed, give thoughtful opinions on them. But if you put them behind a 12-burner stove with a chef that just quit and an assistant that just cut their finger off, they'd have absolutely no bloody idea what they're doing. So having started my career as an investor and then becoming a CEO of a small business for as long as I have, the level of respect and empathy that I now have for CEOs and operators is just orders of magnitude different than it was prior to me becoming an operator. And so now as an investor,
I'm glad you said that because I get these phone calls from search fund guys and gals. I think I might have gotten on a blacklist somewhere because I was getting them all the time, and they've started to slow down as I became less and less patient with them. But they're inevitably 30 years old. They've never done anything. They've got an MBA, and they're all of a sudden going to want to buy my company. And I'm like, yeah. What on earth do you know about running this company? You have an MBA, which is theoretical information. You were like a greeter at Home Depot. You went and got an MBA, and now you want to run my company? How does that make sense? And so there's a huge, variance among these search fund folks. I'm sure there are good ones. I've happened to run into a lot of the bad ones. So we're going to dig into that today. Before we get into search fund land and your world, I want to talk about MicroA, the business, because you were in this kind of search world and you bought this company. So walk me through that.
Sure. So in my case, I got my MBA in the US and moved back to Toronto to commence what I thought was a 2-year search. And it roughly took me about that long, just under 2 years to identify MicroA. I connected directly with the father and son founding team. I happened to catch the right people at the right time in that they were looking to transition the business to the next group of owners. However, over time became very disillusioned with the typical exit paths that your that your listeners will be very familiar with, broadly speaking, private equity and strategics. At a high level, they grew to develop a high distaste for private equity. They didn't like the idea of their company being one asset in a portfolio of assets. They didn't like the fact that they wouldn't have a personal relationship with the individual running their business. They didn't like the fact that they had a very finite ownership period. And similarly, they didn't like the idea of selling to a strategic because in their mind, quite accurately in my experience, they worried that their company would basically cease to exist and be gobbled up entirely several years after acquisition. And so the way that I described a search fund to them is I basically said, hey, I'm a succession plan that's looking for the right business to succeed. And I think yours might be it. And that really resonated with them. They liked the fact that I had a portfolio of one. I had no other assets on which to focus my time and attention. They liked the fact that I was not only the owner of the business, but the person who was going to be operating the business. And during the transition period, we had already created, a lot of water under the bridge vis-a-vis our relationship. And frankly, they liked the small things. They liked the fact that I was going to keep the company's name. They liked the fact that I was focused on growing the company, because if the company didn't grow under my ownership, I wouldn't get any value. They liked the fact that 99.9% of my own net worth and the entirety of my career was tied up in this one single illiquid private asset. And so, look, the price had to be good enough. The structure had to be good enough. But once we kind of passed that bar, ultimately, it was the more qualitative considerations that really got them over the bar and really got them compelled to the idea of selling to an individual, not like a nameless, faceless private equity firm or corporation. So I bought the company in 2014, had roughly sure.
So Steve, let me just pause you. I just want to just a couple of questions about that. Roughly how big was it at the time in terms of number of employees, revenue?
Yeah, so at the time it was about 6 million of revenue and about 33 employees when we bought it.
Got it. And can you share a little bit about valuation structure, how you went about buying it?
Yeah, so those who are looking for to acquire software companies today might wince at this, but we were able to buy the company at an EBITDA multiple, which in today's market tends to be less and less common. Software businesses now at less than 30 million of ARR tend to go for anywhere between 3 to 6 times recurring revenue. But at the time, the market was different. We were able to buy it at an EBITDA multiple. And fast forward 7 years later to when we exited, we were able to sell on a revenue multiple and were able to benefit from the delta between those two.
Great. And so were they getting offers from private equity that were, similar to what you were offering? Like you mentioned, they sort of talked to private equity, they talked to corporate. Like how was your offer relative to what they were seeing from private equity?
Yeah, they had received several offers from both categories of buyers. So beyond the distaste that they developed that I had already described, I think one of the things they really didn't like about private equity was the essentially the necessity for them to stay with the business. As so many of your listeners might relate to, certain types of sellers want to transition out, responsibly, but ultimately they want to transition out as quickly as is reasonably possible. Private equity didn't like that because they weren't operators; they were financiers, and they needed the father and son team to continue to operate the business, and that just wasn't what was in their plans. The father was in his early 70s, and for understandable reasons, wanted to transition out. So he liked the fact that we were able to craft a transition plan together. And again, the whole reason why I was doing this was to be an entrepreneur and a CEO myself. So, in a respectful way, I ultimately wanted him to transition out because I wanted to put my fingerprints all over the business. So that was something that appealed to them relative to private equity. And relative to the offers that they were getting from strategic acquirers, it was mostly the idea of, hey, 12 to 24 months post-sale, I feel as if our company in every meaningful way is going to cease to exist. It's going to be gobbled up. It's going to be unidentifiable. And that's not the legacy that I want to leave. And I'm also fearful about half of my employees being rationalized because our acquirer already has an HR department. They already have a finance and accounting department. They already have software developers. And so they felt, at the risk of putting words in their mouth, they felt that they were doing right by their employees to sell to an operator like me who would continue running the business as a going concern independent entity.
And I guess what I'm trying to drive at, Steve, is how much of a discount did they have to take for that privilege to not sell to corporate, to not sell to private equity? Was it like 10% less, 50% less? Like that's kind of where can you put an estimate around that?
Yeah, my guess is, so it was a proprietary process, meaning that they did not hire an investment banker. They did not hire a business broker. It was just a personal dialogue between myself and them. And I was the only buyer at the table, so to speak. So I didn't have other offers against which I could benchmark my own. But I would estimate that they probably left a little bit of valuation on the table. I'd say much closer to 10% than 50%. And I think that goes back to the point that I had articulated a few minutes ago, which is, look, price has to be good enough and structure has to be good enough. If I offered them $1 for their business and I offered them, the most gracious and fantastic transition plan they'd ever seen, obviously they wouldn't take my offer seriously. So price and structure had to be good enough and pass a particular bar. And in this case, they had a number in their head, a number that would be sufficient for them to do what they wanted to do with the rest of their lives. And that number happened to equate to a palatable valuation for a buyer like myself. And as a result, both of us were happy.
What's palatable? And can you share a little bit around multiple of EBITDA?
Yeah, so we were able to acquire that company at roughly 5 times EBITDA. Which in today's market, again, would be a steal, all else being equal. But again, at the time, it led to a absolute dollar value that was more than satisfactory for them. And in a fortunate set of circumstances, that absolute dollar value just happened to divide quite elegantly into the company's EBITDA and produced a very palatable valuation multiple for us as the buyer. So, in my experience now as an investor investing in these types of businesses, I think buyers tend to think a little bit too much in multiples and often don't give enough respect to just the simple dollar amount, because it is quite, I have observed quite frequently that sellers often have a dollar amount in their head that they're looking for. And that dollar amount is sometimes entirely divorced from the economic realities of their company. Now, as a buyer, that can work against you sometimes, right? Sure. The seller might have a $30 million number in her mind, but her company only generates $500,000 of EBITDA. And as a buyer, you're never going to transact on that business because valuation expectations and multiples are totally dislocated. But in select circumstances, like the one I was able to benefit from in 2014, that division actually worked out pretty nicely.
I've heard it described before, and forgive me, I can't give credit where credit is due because I can't remember who said it, but they said, look, if you're going to try to buy a company, put it on paper for the owner. All they can do is say no. But when they see that number for the first time in their lives with all those zeros following it, in some cases, it can be validating and separate from the theoretical, which is, I want 7 times EBITDA. I won't take a penny less than 7 times, whatever the number is, and say, wow, this is enough money for me to do whatever I want to do for the rest of my life. And they 100%. Don't really focus on the multiple of EBITDA, multiple of ARR, or whatever. Yeah,
100%. And something for your listeners to be mindful of is now, as a buyer and investor in these types of businesses, working with other searchers in this case, so those who are also pursuing the search fund acquisition vehicle, one of the best practices as a buyer is to issue LOIs very frequently. From a legal standpoint, I think it's important to note that LOIs are barely worth the paper that they're printed on. And in fact, as a buyer, you don't really give up much at all when you issue an LOI. But as a seller, you give up a lot. You give up exclusivity, which is I am not allowed to talk to any buyer other than you. So that's a big give. As a buyer, we don't really give a whole lot, but we get a lot. What do we get? We quickly surface your valuation expectations. If I think you're worth 5 million and you think you're worth 50 million, I'm just going to walk away that day and I'm going to save my valuable time because the bridge between us is just too long. So I quickly surface valuation expectations. The other thing I do is I quickly surface structural expectations. Most people who have never sold a company before understandably think that I'm going to get 100% of my proceeds in cash. But as you know well, John, that is very, very rarely the case. And so when they see a very official looking legal document that says, I want a 10% roll and a 30% seller note, you quickly surface whether that is even palatable for them. And so as a result, issuing offers with a high degree of frequency is one of the best time-saving tools that we have as buyers. And to your point, it's one thing for us to verbally discuss valuation, but there's just something about seeing it on a very official looking legal document that tends to just separate the real sellers from the tire kickers.
Such a good point. How did you structure your acquisition? What percentage up front? How did you structure it? Seller's note versus earnout, or what was the structure?
Yeah, so we kicked around a bunch of different structures with the sellers. Ultimately, what we landed on is, I believe it was like 60 or 70% of the cash up front. That was funded by a combination of equity and debt. And then the remainder in the form of a seller's note, which I believe amortized over a period of 3 to 4 years and earned some level of interest that was many, many multiples of the prevailing interest rates at the time, which were basically zero. So they viewed it as a way to effectively reinvest in their business, earn a reasonable rate of return. And from my standpoint, I viewed it as a great tool for alignment of incentives between myself and the seller, because like many small businesses, I saw some key person risk in the seller. I wanted to make sure that he had the proper incentives to not disappear off to a beach the day after closing.
Okay, let me just unpack that. So 60% cash, you mentioned a portion of that was equity, a portion of that was debt. So you personally put in some cash and then borrowed some money to come up with the rest of the 60%. Is that correct? Borrow some money from a tier one bank, or?
Mostly correct. So the debt was from a tier one bank, one of the big 5 banks here in Canada. And then the equity came from my own investors. So when I raised a search fund in 2012, I was financed by a bunch of high net worth individuals who paid for my expenses during the 2-year search process. And in return for doing so, they had the right but not the obligation to invest in the company that I ultimately uncovered. And in this case, enough of them were willing to invest, and they helped me write the equity check. So part of the magic of being an acquisition entrepreneur is you can be the owner and CEO of a company without putting down a dime of your own money. And at the time, I didn't have any money because the only thing that I was the proud owner of was about $100,000 of debt incurred by virtue of going to business school in the US.
Okay, so what does the search fund investor, the person who invested in you, get out of, like, how do you make any money? If it's the investor's money that you're investing to come up with a 60% cash and some debt that you borrow from a bank and you personally guarantee. So how do you make any money in the deal?
Yeah, good question. So most search fund entrepreneurs tend to be relatively early in their career. And as a practical result of that, we don't have a lot of money to put into any company that we buy. So as a result, we kind of earn our way into equity, and we do so in 3 different ways. Often we can earn up to 30% of the equity in the company. So the first 10% is granted to us upon acquisition, which is to say we become 10% owners in the company simply by virtue of buying it, right? Which is typically a pretty intense process, as you know, and you're doing it largely on your own. The second 10% that we can earn is time vested, typically over a period of 4 or 5 years. So every month over the next 4 or 5 years, I get an even share of that second 10% bucket. The final 10% that I can earn depends on the return that I ultimately give to my investors. So if I give them a fantastic return over and above some agreed upon amount, then I'll get all of that third 10%. If I deliver a lousy return, then I'll probably get none of that final 10%. And if I give them something in the middle, then I'll probably get something in the middle.
Got it. Okay. So let's go back to the structure for MicroA. The 100%, the full pie, 60% of that pie came from, was cash that the owner, in this case, the seller, got. And behind the sheets, that 60% came from 2 parts. One was debt you borrowed from a bank, and the other was equity that your high net worth investors backed you on. And for that, you then earned 10% up front, another 10% over time, and then another 10% when you went to sell for a much higher multiple. The 40% seller's note. So this is where the seller lends you the money to buy their company with the recourse that if the business fails, they get their business back. Is that correct?
The recourse that you have is commensurate with your position as a lender, which is to say that, like, as an equity holder, I don't see a dime until you get paid back. So I want to make sure that that's clear. You are
So
a
I
lender to the company.
Yeah.
What I mean, maybe I'm muddying the waters between recourse and covenants, right? So typically seller notes have no covenants, which is to say the EBITDA could go up, could go down, my indebtedness could go up, could go down. But it's not as if you get to take the company back over if I breach some sort of agreed upon covenant. But you are very much a lender to the company. So my equity has no value until you get paid back in full.
Got it. Okay. That's super helpful and a good education for me. So you would presumably, as a seller note owner, sit below the tier one bank. They would have first sort of dibs on anything.
Yep.
And then you would be behind that effectively, but ahead of.
You would be behind the senior debt, but you would be ahead of all equity holders, including and especially myself and my investors.
Okay, so you're not able to pull out anything from the company. Let's say you're 5 years in, you're the CEO of this business, and you're like, you know what, I kind of like to pull out some cash here. Can you do that, or does that first need to go to the tier one bank, and then walk me through that?
So typically with tier one banks, it is within the negotiated agreement, and they often say something to the effect of you cannot pay dividends or do recapitalization or sell the company without the bank's prior approval. That is very, very common. So I couldn't issue a dividend or do a recap or something like that without first calling the bank and saying, hey, here's what we want to do. And the bank has every right to decline our ability to do that. In a seller's note agreement, you can negotiate those types of provisions, but in my experience, they tend to be the exception rather than the norm. So for example, if I'm buying your business, John, and your seller note is still outstanding, most often I can still issue a dividend to myself, or pardon me, not to myself, but to the equity owners of the business. However, I couldn't do that if doing so would put us in default or impair our ability to pay your seller's note. However, if I buy your company for $5 million and 2 years from now I want to sell it for $5 million, I don't get a dime because I have to first pay you and I'd retire your seller note before I get basically whatever's left over. So I, as the equity holder, only get the upside. You, as the debt holder, get whatever was originally owed to you, plus the accrued interest that has accrued over however long the seller note has been outstanding. Okay,
I think I got it now. So I understand this. You bought it for 5 times EBITDA or thereabouts, structured at 60-40, had some backing. And then you ultimately sold the business 6 years later. And you mentioned there was, when you bought it for a relatively modest multiple of EBITDA. But by 2020, when the market was humming and companies had gone from selling on multiples of EBITDA to multiples of revenue, or at least software companies, you were able to sell the business for a multiple of revenue.
Yes, we actually, and we can get into this or not, depending on your preferences, but we actually tried to sell the business in 2018 unsuccessfully. And we went through a very formal process. We hired an investment bank. We received and solicited bids on the company. We chose a private equity firm to go exclusive with. And, from start to finish, this entire process took about a year. And then quite late into the process, when the purchase agreement was being drafted, it fell apart. It fell apart entirely. So we can get into the reasons why. But as an owner, I felt a pretty meaningful kick in the gut at that point. And that is, for me, when fear of failure really became a pretty acute fear. To make a long story short, I'd say a couple of things. One, the performance of the business had started to decline over the period of that 1 year of due diligence and the entire sales process. I think one of the reasons why is because I found it incredibly difficult to balance selling the business, which was a full-time job, and running the business, which in itself is more than a full-time job. And I think the time and attention of myself and my management team started to get diluted in such a way that the day-to-day performance of the business started to deteriorate a little bit. I mean, not hugely, but we weren't exactly hitting it out of the park. The second is, I think, as the diligence progressed, it became increasingly clear to the buyer that there was some key person risk that resided entirely within me. At the time, our management team was pretty thin. I think we had myself and 3 other people. But by the time we sold in late 2020, there was like myself and 7 other people. And that was one of the key lessons that we learned from our first attempt at selling, among many other lessons, is that I shouldn't be the one doing the entire management presentation, because if I was, and when I was, it became very clear to prospective purchasers that like a lot of things came and went through myself. So those, largely were the 2 reasons why the deal fell apart. Instead of kind of going back to market, we frankly were exhausted and didn't want to go through the process again. So we put our heads down and we started to apply a lot of the lessons that we learned in trying to sell the company in 2018. And then by the time we actually did sell in 2020, a lot of the things that precluded the first deal were no longer issues for us.
The company had grown to a point where there were more managers in place, and you were no longer personally kind of doing 2 jobs at once. The performance was not deteriorating at the time.
Yeah, and the second deal was actually much faster than the first one. We were very fortunate in that we had a relationship with our buyer, kind of a loose relationship, but a relationship nonetheless for several years. We check in every 6 months or so. Through the industry grapevine, we came to learn that they were in acquisition mode. And I think through the industry grapevine, they eventually came to appreciate that we were, willing to sell under the right circumstances. And as a result of, both of those interests coalescing pretty elegantly at the same time, the entire process from start to finish took maybe 3 months, whereas the first opportunity took, upwards of 12 months and ultimately wasn't successful.
So in the second case, in the 2020 deal, were there other players at the table, or was it just this one acquirer?
It was just this one. In the first instance, we ran a very competitive process, and we solicited and received, I think, upwards of 12 or 13 bids for the business. So that helped us appreciate what a competitive process might look like. In the second instance, even though, I've read all the books and certainly at an intuitive level understand that, one should try to create as much competition for their business as possible, it was a very, very logical home for our business. The company to whom we sold was competitive enough, but also complementary enough such that it made a lot of sense for them as the acquirer and for us as the seller. Also, frankly, John, from a personal perspective, I found myself utterly exhausted, and I was experiencing burnout at the time, which, up until that point, I thought was just a fancy way to say I was tired, but I came to appreciate was actually a clinical diagnosis that required meaningful treatment. And I think I got to the point where I was just so tired. I went to my board and said, look, this isn't really something that I want to keep doing. I want to make sure that we put our business in the right hands. And I want to make sure that I'm kind of handing over a stable patient, and I'm not putting the board and the investors and the management team in a perilous position. But I just want to be clear that I don't really see myself running this for much longer. And I want to spend more time to focus on my mental health, my physical health, my family, et cetera. And thankfully, I had a fantastic board who was very deeply understanding. And they basically said, okay, if you want out, then we want out, and let's go and find our buyer. And fortunately, we had an existing relationship with our buyer. We knew the timing was right for them. We knew the timing was right for us. And one of the things that they offered was the opportunity for a very quick and very clean close, which they actually delivered on. And if that meant that I personally had to take a little bit less money in return for a quick close and a quick exit and a very clean exit so that I could focus on the things that I wanted to focus on, then that was a trade that I very, very happily made. And I, to this day, have no regrets about it.
And so could you ballpark the difference between the 2018 offer that was the culmination of a formal process with 12 bidders and so forth, the one that fell apart, versus the 2020 offer that was effectively just a proprietary deal, a structured deal that you negotiated yourself? How much of a difference was there between those 2 offers?
So the biggest difference with respect to the 2 offers was structure. So the first one in 2018 was with a private equity firm. And at the time, for reasons that we've already discussed, they wanted me to roll 50% of my proceeds of the deal, which is to say all of my investors would be happily paid out. But if I were to earn $100 from the sale, I would take $50 and immediately reinvest it in the business such that I would only take home $50. And that makes sense. They were private equity investors. They needed an operator to actually run the business, and they thought that operator ought to be me. In the second sale in 2020, it was from a strategic. This was a well-financed private equity-backed company that already had operators, and they had a very, very deep management bench. So, candidly speaking, they didn't particularly need me. They wanted to make sure that there was a responsible transition process, and my managers were there to help them, and all of the things that you would reasonably expect. But for that reason, they didn't require any role from me. So I was able to pocket my proceeds individually up front. And again, when one lever is pulled, all the other levers tend to need to move to maintain balance. So in my case, we got a very favorable structure. I got a clean exit. I got a quick process, and I had a minimal transition period. But what did I give up for that? I probably gave up some valuation, and our investors probably gave up some valuation. But we were pretty clear-eyed.
Could you estimate on a percentage basis what that might have been? The percentage?
It's really tough to say. I really don't know how much we otherwise would have gotten had we received a more traditional structure. But at the end of the day, not everything that's important needs to be quantified, and not everything that can be quantified is important. And so for me, I felt good about the economic outcome that my investors got. I felt great about the economic outcome that I got. And I felt jubilant about the fact that I could now spend more time with my wife and my young daughter at the time and pursue interests that had nothing to do with running a company. And so I kind of happily left some amount of money on the table. Exactly how much money that was to this day, I'm not entirely sure.
Got it. And that's, of course, the trade-off that a lot of folks will need to make is how comfortable they are with equity, how much they want to stay on, and what they're willing to give up if the answer to those two things are nothing. That's interesting. Walk me through the return on investment the investors got. So your original structure was 60% cash, 40% seller's note. The 60% was made up of some debt from a bank as well as some equity. So for every dollar of equity those high net worth individuals put into the deal, how many dollars did they get out 6 years later?
Yeah, so the gross return was about 4 times. So by the time we sold, the bank had been entirely paid off. I think we paid off the loan within our first 3 years. The seller note had been paid off with interest, obviously. And so we sold the company on a debt-free basis. And obviously we used the company's cash flow to service both debt instruments. And so by the time we exited, our investors got roughly a 4x return, or said another way, equity value increased by about 4 times over our just south of 7-year hold period.
Got it. So they could have stuck their money into the stock market and expected to maybe double it if they were doing well during that period. And instead they gave it to you and quadrupled it.
Right.
Fair way to think about it.
Fair way to think about it. And I think at the beginning of the conversation, when you described search funds in their most basic form, you're right. It sounds like a bit of a ludicrous concept when you think about it. I remember explaining it to my mother in 2012 when I first decided that I wanted to leave private equity and graduate Harvard Business School and, go work in a windowless rented office to find a private company that nobody's ever heard of to buy. And she said, "So hold on, people are going to give you money and you don't even know what you're going to buy?" I said, "Yeah." And she said, "But you've never run a lemonade stand in your entire life and people are still going to give you money?" I said, "Yeah." They said, "What company are you going to buy?" I said, "I have no idea." "What industry are you going to buy in?" "I have no idea." She's like, "I cannot believe that people are giving you money." And honestly, to this day, I don't blame her for thinking that. It sounds like a ludicrous concept. However, search funds as an investment vehicle have been around since the mid-'80s. And over many, many decades have outperformed in a very meaningful way. Private equity, private debt, venture capital, real estate, public markets, private markets. On average, we generate returns of about 5x, which equate to an IRR of roughly 30 to 32%, which is, frankly, world beating if you compare it to more traditional asset classes. So though it indeed sounds absolutely preposterous to sell your company to a 27-year-old who has never managed as much as an administrative assistant in her entire career, the data is overwhelmingly clear that there is something magical about getting a young, a highly educated, highly pedigreed entrepreneur to run the right type of business in the right type of industry and have his or her sole focus on that singular asset. I mean, after a couple of decades, you kind of just have to take the data for what it is.
And so if people want to invest in these structures, be the equivalent of the high net worth individuals that gave you money back 10 years ago, is there some sort of exchange, or is it all done quietly between accounting firms? Like, how do you find these deals to invest in?
Yeah, so people like me will invest in searchers. So these tend to be, let's call it late 20, early 30, highly pedigreed, highly experienced professionals who come from it's a bit of it's a small yet growing ecosystem. I'd say that the greatest kind of source of talent would be the business schools, primarily the business schools in the US. So the top 20 business schools, and this was not the case 10 years ago, the top 20 business schools, Harvard, Stanford, Wharton, Kellogg, Dartmouth, etc., now have formal education. It's called Entrepreneurship Through Acquisition. They have clubs, they have conferences, they have second-year courses. So now substantially all MBA graduates in the US, fewer in Canada, are introduced to the concept of entrepreneurship through acquisition formally in their second year of their MBA program. And some small percentage of these graduates, instead of going to work for McKinsey or Goldman Sachs, will hang out a shingle and attempt to search for and ultimately acquire a single privately held company. So investors like me usually have relationships with those schools and with those clubs and with those professors. And we try to back the next generation of, small private company owners in North America who are looking to fulfill their entrepreneurial dreams. And maybe they just don't have that great idea that they can start in their garage, but they have the desire, the grit, and the skill set to run something. But instead of starting something from scratch, they're choosing to buy their way into the entrepreneurial career that they've been seeking.
Got it. But it is a different type of individual, right? Like, a lot of the pure play entrepreneurs I know are not that highly educated, right? They've got maybe a good degree, but they're certainly not. They certainly weren't the smartest kids in the class. What you're describing, people who go to Harvard or Stanford and get an MBA, that's a different type of person, right? Like that's a formally educated, usually systems structure. That's a different type of person than would be the guy or gal who starts a lemonade stand and grows the next giant, beverage company.
I think it is. And I think that is true in the most constructive and positive of ways. So in my experience as an entrepreneur and now as an investor, is generally speaking, the people who bring a company from 0 to 5 million are not always the people who bring it from 5 to 20. And those people in turn are not always the same people who bring it from 20 to 100. As a business matures, it's that the demands on the CEO change and what is required of the leader of those companies change. And so, for example, like in a very practical way, my sellers were incredibly talented entrepreneurs, but they fell into a reasonably typical, I don't want to say limitation, but what I often saw is that they had been trained as they founded the company from scratch to basically say yes to everything. If you're a customer that wants a request, that has some sort of feature request, we're going to say yes, because your money is as green as the next guy's money. While that makes a great degree of sense when you're building a company from nothing to something, it makes significantly less sense when you're trying to build a software company from $5 million to $20 million in ARR. Specific to software, you want to do something that we often refer to as build once, sell many times. Don't build many times and sell once each. And more of a system and process orientation that I brought to the table is something that my sellers didn't necessarily have. Another thing that they did, and again, this is not to be disparaging of them in any way. They obviously built a company that I thought was impressive enough to bet my entire career on. They did a lot of the sales and the marketing themselves. In fact, they had no marketing. And the seller or the CEO at the time himself was doing most of the selling. That's fine when you want to grow a company from nothing to something. But when you want to really scale it, you have to build out a real sales team with real compensation plans and real leadership and real structure around it. And that's not something that the company had in place. So I agree that the pedigreed 30-something MBA graduate who comes from McKinsey or Goldman Sachs does indeed bring a different skill set to the business. But that is the magic of the model, is that we do bring a different skill set, and we can see things that the owner may not have necessarily seen, him or herself, because they've just kind of been in the trenches for 20 years.
When does it not work? You painted a very glowing picture. I want to get my checkbook out and find the next, Harvard MBA with an idea. But when does it not work? When does it all fall apart?
I think like any investment or like any commercial undertaking, there are plenty of instances where these don't work. Now, on average, clearly they do. But I would say a couple things tend to happen. One could be the relationship between buyer and seller sours within that transition period. It's my experience that buyers or incoming CEOs tend to underestimate how emotionally difficult it is to placate the outgoing sellers and to explain every decision to them, to make sure that they're on board, to make sure that they understand why they're doing it. It's also my experience that outgoing CEOs, or the sellers in this case, underestimate how difficult it will be to watch somebody else make changes to their baby, even the most minor of changes. And sometimes that can create friction. And I think friction at the highest level of the organization has the potential to damage a company far more than competitors fear-mongering or employees quitting ever could. So that would be kind of one theme that is certainly a possibility and a bit of a danger zone. The second would be buying the wrong type of company. So sometimes founder centricity is kind of like a cost of doing business with respect to small business acquisitions. Like almost by definition, most of these companies tend to be quite dependent on their founder. But if it is like asymmetrically dependent on the founder, and the founder disappearing will hamper relationships with existing customers or the company's ability to acquire new prospects, that could certainly be a bit of a danger zone. I would say buying too small of a company, we often tend to see it with really, really small acquisitions. Almost by definition, smaller companies tend to be more dependent on that seller. And I would also say buying the wrong type of business from like an economic and business model standpoint. So the kind of like caricature of a search fund transaction is, often people joke that we all look for the same business and we all look for a perfect business, right? We want recurring revenue, we want industry tailwinds, we want no customer concentration, we want low capital intensity. And I remember when I first described what I was looking for to a broker, he kind of laughed at me and he said, "Oh, so you're looking for the perfect business. Sorry, I don't have any of those for you." But the reason why so many search funds target businesses that could be described by some of the things that I just mentioned is because those types of businesses unambiguously are easier to run. It is easier to run a recurring revenue business than a project-based business. It is easier to run a company that has high customer switching costs than one that has low switching costs. It is easier to grow a company in a large growing market with plenty of white space than a stagnant competitive market where you're looking to just replace incumbents. So yes, it is probably a fair criticism that it sounds like all search funds are trying to acquire the perfect business. But really what we're trying to do is to acquire a company that lends itself reasonably well to being run by a first-time CEO and creates enough of like a financial and operational cushion such that we can make first-time CEO mistakes and not like imperil the existence of the business. So that's why we're looking for the types of businesses that we tend to buy.
Yeah, it's funny. I was very critical with the Home Depot greeter comment at the very beginning, but the reason I think I was so critical, or I am so critical or skeptical, is that the email themselves look virtually identical. Like the email that I get from each of the it's like they got a template at school and they're changing the first name, but it's like the same, you want to protect your legacy, have a transition, we're looking for this type of business. Like it's like the same email. And I'm thinking, man, if you gotta show some creativity, some interest in the business, the industry, the category in order to
100%. Look, I think like any like in any asset class, not all buyers are created equally in the search fund asset class. So there are some who are more compelling than others. The other thing that I'd say is like, I could apply that same lens of skepticism to any other class of investors. So show me a venture capitalist website that doesn't say we are founder first and we are founder friendly.
So true.
Show me a private equity website that doesn't say we are flexible, patient, long-term capital, willing to meet the owner, halfway from a structuring and transition perspective. Everyone kind of says the same shit, right? And so it's important to try to differentiate yourself as an individual and as a buyer and understand like what is truly important to the seller in question, because it's not always created equally.
Yeah. So again, that is a great context. Let's talk about what happens if it goes wrong. So I understand the reasons it might go wrong. So let's take the outgoing seller and the incoming owner are at loggerheads over key strategic decisions, and they get frustrated. That frustration makes the business suffer. They're spending too much time arguing and not enough time serving customers, and so the business starts to crater. I'm assuming the first trigger is they miss a covenant on the bank debt from the primary lender. Is that usually the first domino that happens?
It could be. I mean, not all acquisitions are financed through third-party debt. Some are financed through seller debt. Some are not. Some are all equity. It depends on the context in question. But that would be probably a representative example of like the first sign of trouble. Okay,
so something goes wrong. They flip a covenant, or they're outside a covenant, and so they need to get on side. They don't have the cash to pay back the loan because their business is struggling. They fired the AR clerk, and as a result, they're in arrears, and they just don't have the cash to pay off the bank sort of structure. Eventually, the primary lender would presumably, like, what is their nuclear option? To shut the company down and try to liquidate it for its assets? Like, what is their, like, if they need to just get their money back, what do they do?
Yeah, it's no different than any other creditor relationship, whether that creditor relationship was created through the purchase of a company or whether you just wanted to take out a line to finance some capital expenditures. The right of it, substantially every senior lender, is to take over your business, right? The loan is usually collateralized with shares of the company. Now, the good news is that banks are not in the business of running small companies, so they don't want to run it. It is a huge administrative burden. They don't know how to hire CEOs. They themselves are not operators, so they don't want to do it. When one trips a covenant, what is way more typical is a restructuring of the loan. So hey, instead of me agreeing to pay you back in 5 years, let's stretch it out. I agree to pay you in 10 years. Instead of paying you X% in interest, pay me Y% in interest for the next couple of years until you shore up the house, and then we can raise it back to the original. So that would be like a loan restructuring. That is much more typical when a covenant is tripped than the bank just taking over your business outright. Because again, they don't want to do that. That is indeed like the absolute nuclear option. So that tends to not be terribly typical, again, just because the bank's incentives are set up in such a way that they just frankly don't want to do it. But yeah, as in any creditor relationship, the bank certainly has that ability.
And have you, as the acquisition entrepreneur, the search fund participant, whatever you want to call it, have you signed a personal guarantee on that debt?
Typically, no. So in the US, personal guarantees are more common. However, they tend to only be, or at least mostly be present under the US SBA 7A loan program. This is a very unique program that the US has that Canada, unfortunately, doesn't really have an equivalent to. But it basically provides acquisition entrepreneurs with 10-year covenant-free debt to acquire a company and finance up to 90% of the purchase price of that company with this 10-year covenant-free debt. It all sounds fantastic until you realize that there's a catch. And that catch is a personal guarantee, which is to say, if your company defaults on that loan, they can take your house, they can take your cars, they can take your 401k, they can take everything from a personal standpoint. So certainly a contrast between risk and return. In Canada, we don't really have a similar program. And so typically our loans are issued by the big 5 Canadian banks. And in the vast majority of those cases, they do not feature personal guarantees.
Okay. That's helpful. And again, these businesses generally are larger, so they're a little bit more stable. In your case, 6 million in revenue, healthy EBIT of 30 employees. So it's not a startup company they're backing. In this
Exactly.
That makes sense. What advice would you have for someone listening thinking, man, I'm really loving what Steve's talking about here. I think I want to be an acquisition entrepreneur.
Yeah, it's a great question. I mean, look, I was not aware of this model before matriculating in business school in 2010. And when I learned about it, it really broadened my definition of what an entrepreneurial career could be, especially for someone like me who had an investing oriented background. So I felt like it was a bridge between where I had been as an investor and where I wanted to be as an operator. So at the end of the day, you kind of have two options, broadly speaking. I'm oversimplifying just for the purposes of giving you a soundbite. So you could self-fund a search, which is, you could operate from the guest bedroom of your house if you wanted to and start emailing business brokers and investment banks and business owners and pitching them on the idea of selling it to you. Once you get a target in mind, and let's say you get them under LOI, you'll have to start raising equity for the purchase of that company. And you can do that from anywhere. High net worth individuals, family offices, whatever the case may be. That's kind of like the less formal way to do it. The more formal way to do it would be to raise something called a search fund. So that's where you would call people like me who invest in these things as our profession. We say, okay, as a group, we will give you, $500,000 to fund a 2-year search for a company to buy. That'll pay for your salary, your travel, your office expenses, etc. In return for giving you that $500,000, we get the first right to invest in whatever business you decide to acquire. Now, we don't have to invest in it, but we certainly have the option to invest in it before you're legally permitted to show it to anybody else. So from an investor's perspective, it is a way that we can put our money where our mouth is vis-a-vis supporting the entrepreneur in question and helping them along their journey in terms of how to find these companies, how to evaluate them, how to structure them, et cetera. In return, we get the opportunity to invest in potentially an off-market compelling deal that is probably too small to be on the radar of a traditional private equity firm. And so the entrepreneur gets, the searcher has the opportunity to live the entrepreneurial career that they had been dreaming of and to have the autonomy and independence and freedom associated with being an entrepreneur CEO. And investors like me have the opportunity to put our money into small private companies that are just impossible to access unless you're part of this small but emerging search fund ecosystem.
What percentage of the time does the searcher fail to find a business and the money that is lent or given to them basically goes to zero?
About a third of the time.
Got it. So not an insignificant proportion of time does the search basically, it's just some money. You give them $500,000, here's your office, here's your, your car, your travel, and a small salary, and they come up with nothing.
That's right. It certainly is a possibility. But the way that I thought, so certainly people might be surprised to hear this from a lifetime entrepreneur, but I'm actually an incredibly risk averse person. And so one of my mentors said to me something that I'll never forget when I was asking him about should I be an entrepreneur given how risk averse I am? He said, the biggest myth about entrepreneurs is that you're born risk takers. He said, that's not true. Entrepreneurs are born risk mitigators. And so what really appealed to me about this search fund option as a prospective entrepreneur is how it mitigated so many risks. I mean, there is no model that I'm aware of that can completely eliminate entrepreneurial risk, but this one mitigated it as well as I think it can be mitigated. So from a time perspective, I had 2 years to find a company. Well, in the context of an average 40-year working career, 2 years represents 5% of one's career. So that's my downside. It's quantifiable, it's known, and it's capped. But what was my upside? Well, measured in terms of not just financial upside, but freedom and independence and control and opportunity. I mean, it was hundreds, thousands of percentage points. So I saw big asymmetry between downside and upside. And then once I became a CEO, if I did, then I'd be earning a market CEO salary and earning equity in a small growing company without putting any of my own money into it. Because again, very practically at the time, I didn't have any money to put into it. And, for me, that felt like a very mitigated approach to taking the entrepreneurial leap. when you contrast the success rate of search funds to, let's say, the success rate of being a founder of a venture funded startup, I mean, they are orders of magnitude different in favor of search funds. There's just something fundamentally different about buying an enduringly profitable company that's been around for 30 years, as opposed to like starting something from scratch and hoping to find product market fit in the first couple of years.
When you're sitting in a classroom and a very compelling professor who's had 30 years experience in a certain model describing it, can be temptingly, intoxicatingly simple, at least in theory, when you're hearing it described as a business model. Yet I would imagine that once you get into the day-to-day operations of a company, it becomes much more sobering, perhaps, is the best word I can come up with. What was the most surprising thing that you found running a company that you did not expect sitting in an amphitheater in Boston hearing about the theory?
Yeah. John, how much time do you have? I could talk to you for the next 3 hours about this. Going back to my somewhat crude analogy of the difference between a chef and a food critic, I think entrepreneurship and leadership is romanticized in a lot of different places, society at large, but also certainly within the world's leading business schools. What did Elon Musk say? Something about like being an entrepreneur is like eating glass every day. That's pretty much what it felt like. I often describe it to prospective searchers as I got punched in the gut 10 times a day and I'd wake up with a big smile and do it and happily do so again the next morning. So it's certainly less of a romantic undertaking than I thought it would be sitting in that amphitheater in Boston. I think like to summarize it, one of the things that I didn't really appreciate that I now appreciate in my bones is like the phrase "it's lonely at the top" exists for a reason. It sounds cliche, but boy, is it true. As a CEO, I felt as if I often had very few outlets to voice like the personal and professional concerns that I thought had to reside solely with me. I think by definition, nobody understood what I was going through as a leader and as a CEO, including my spouse, including my management team, including my investors. There is something quite intimidating about, hey, the quality of the decisions that I make is going to impact the ability of 72 families to have food on their dinner table. I mean, talk about sobering. Holy smokes. I mean, that is a weight that really, really sits on you. And as an entrepreneur, you eat what you kill, which is to say that like, if you and your company don't make the sale, it's your fault. If there's a problem with an employee, it's your fault. You have to fix it. If there's a problem with a customer that is demanding, too demanding of your employees, it's your fault. You have to go fix it. Hell, if there's a light bulb broken in the office, get your ass on a ladder and go fix it. So it was certainly different from my initial highly romanticized, unrealistic expectations of being an entrepreneur. But, kind of being in the arena, I had a black eye, I had blood all over my face, I'm sweating, I'm cut, I'm bruised, but like, at least I'm in the boxing ring. I'm not the guy in the stands, 20 pounds overweight, critiquing what fighter doesn't know how to throw a left hook or not. I just felt a lot of gratitude and opportunity from simply like being in the arena.
Would you do it again?
That's a great question. I mean, I've already kind of answered that question by virtue of the choice that I've made post-exit to do what I'm doing now, which is to remain as an entrepreneur, but instead of building a business that sells software to trucking companies, which is what our company did, I'm now building a business to help other entrepreneurs realize their entrepreneurial dreams. So I'm building an investment firm. And what I'm trying to do is to try to leverage all the mistakes that I made as a CEO and the difficulties that I endured to try to help the next generation of CEOs, particularly acquisition entrepreneurs, have a much smoother ride than I did and avoid stepping on all the rakes that I stepped on when I was a new CEO sitting in the seat for the first time. So, in terms of how I made that decision, I thought, okay, I could take all the lessons that I learned as a first-time CEO and go apply them again. And I'll benefit one company and I'll benefit one set of employees. That's certainly fine. But I thought if I could work with a dozen CEOs, I could magnify and leverage my impact and help improve 12 CEOs' personal and professional lives. And by extension, the impact that I can have on families and the employees is magnified, times 12 as opposed to times 1. So this was a way that I thought I could leverage all the battle scars that I had gained as a CEO, help others who are in the CEO seat for the first time, and by extension, help all of the families as best as I can, represented by the employees of each of those companies, largely through helping them avoid many of the mistakes that I made myself.
So your firm now is investing in these acquisition entrepreneurs. You're funding
That's
their
exactly
search,
right.
and funding their
Yeah. So now I spend all day, every day investing in search funds and the companies that they acquire across North America.
And this is your capital exclusively, or have you raised capital yourself to do it?
Yeah, it's a mix of both. So I'm certainly an investor in my own fund, but we've also invested, or we've raised a fund to give us the amount of capital that we think we'll need to help, really put a dent in this search fund ecosystem and to support the number of entrepreneurs that we're hoping to support.
And the investors in that fund are who?
Actually, reasonably consistent with the investors in my original search fund starting in 2012. So largely high net worth individuals and some family offices. That tends to be a pretty typical profile.
Got it. And if people want to learn more and reach out to you, what's the best way to do that, Steve?
Best way to find me is actually on my podcast. John, you were nice enough to join me on my podcast a couple of months ago, so people can certainly check that out. The podcast and the blog is called In the Trenches. I've been doing it for 3 years now, and it's basically my attempt to say and communicate to entrepreneurs all of the things that I wish that I knew 12 or 14 years ago when I decided to take the entrepreneurial plunge. So I cover everything from buying a business to managing a business, managing oneself and one's own psychology, and selling a business, because in a very practical way, I've done all of those things. And so, again, this is my attempt at kind of putting the lessons that I learned back into the world and hopefully benefiting entrepreneurs and CEOs at both a professional level, but most importantly, a personal level, something that I take a lot of pride in talking about, the realities of being an entrepreneur in terms of managing your inner world as opposed to your outer world, which I think is something that doesn't get enough time and attention. So I'm trying my best to address that shortcoming as best as I can.
It's called In the Trenches.
You got it.
Grab it where you get your podcasts as well as blogs, and we'll put both the link to the podcast and Steve's blog at buildtosell.com. Steve, thanks for doing this.
Thanks, John.